You, Edel, for that kind introduction, and good afternoon, everyone. First of all, we'd like to thank CIB.O for this invitation, for this honor to speak about the new tax rules that would affect PESA companies, most of the members of CIB.O. So thank you very much for this opportunity. This afternoon, I'll be talking about Attorney Kim assigned a topic based on age. No, I'll be discussing on the old provisions of the VAT treatment, the treatment of transactions of PESA companies. And Attorney Kim, the second part, he will discuss on the latest updates. So the new generation will handle on the recent updates. The not so young generation will discuss on the old provision. So basically, I'll be discussing the basic principles, the guiding VAT principles, and how we treat transactions, specifically for transactions affecting PESA companies. So that's my task this afternoon. Okay, so let's review the basic VAT principles because we will use this later on how we treat the transactions. Okay, so these are basically the basic guiding VAT principles that we have to keep in mind. The first one is about the destination principle. What is this all about? So basically, goods and services are taxed in the country where they are consumed. So, for example, if you are importing goods, then it will be taxed on the country, the importing country. So if company A will, a PESA company will import goods from Japan, then upon arrival, it will be taxed here in the Philippines, the one who is consuming of the goods. So the one who will pay for that will be the importer. And if you are exporting goods, and services to another country, the export is not subject to VAT. So depending on the other side, it might be subject to VAT and other duties upon arrival in the destination country. The other one is the Cross-Border Doctrine. So here it says that no VAT shall be imposed on a product that will form part of the cost of goods destined for consumption outside the territorial border of the taxing country, taxing authority. So the example of this one is, for example, if you are a PESA company, you are buying from local supplies so because your products or your services will be exported. So it's destined outside the Philippines, therefore no VAT shall be imposed. So that's basically the destination principle and the cross-border doctrine, which is our guiding principles in determining the vatability of a certain transaction. Now let's discuss on the nature of the economic zones. Most of us are registered with PESA. So before, the special economic zones or the ecozones are focused on manufacturing. So we have ecozones in Mactan, MEPS 1, MEPS 2, and there's a CLIP, which we usually call MEPS 3. These are mostly industrial manufacturing, but we expanded that to include BPOs, tourism-related industries so that we can attract tourists, foreign currency receipts. So we expanded it, including agro products. These agro-industrial ecozones are mostly present in Mindanao. So that's the concept of the ecozones. So basically, an ecozone is considered as a separate customs territory. It's a separate customs territory because it's operated and managed by PESA. Although there are private ecozones developed by certain private corporations, but the one managing the transactions, the operations, it's still PESA. Now let's discuss on the concept of this separate customs territory. So we have a separate customs territory as compared to the customs territory. What's the difference? In this case, Ecozone is based on this case, no, Sigit case. This is a former client of ours. And if you don't know, Sigit actually was supposed to start their business in Cebu, in Naga. They put up a 1 billion plant, but they decided not to start the commercial operations of this company because of the change of technology. I think the put out the plant to manufacture, I think, CD something, but since based on the trend, the CD industry would be replaced by another one. So they decided not to continue of that 1 billion plant, but they incurred input taxes when they constructed the plant. So they applied for VAT refund on their input taxes, unutilized input taxes. So that's why the VAT refund case reached to the Supreme Court. And according to the Supreme Court, and which we will quote the portion of the decision of the Supreme Court about the definition of an ecozone. An ecozone is managed and operated by PESA, as I mentioned earlier, and that is considered as a separate or customs territory. So it means that we will now, the foreign soil concept will now come in. This means that in such zone is created as a legal fiction of a foreign territory. So in effect, if you are in an inside a ecozone, it's like a foreign soil for tax purposes. So any importations or any purchase of local purchases is considered as sort of an export by the one selling. So therefore, there should be no VAT. So that's basically the concept of a foreign soil. So another case is about it says here that while an ecozone is geographically within the Philippines, it is deemed a separate customs territory and is regarded in law as foreign soil. So that would support the case of Seagate that an ecozone is like a foreign soil. So that's why when a PESA enterprise will sell locally, for example, sell goods to a local buyer, it's like considered as a technical importation by the local buyer, and they will be the one paying the VAT and the duties corresponding to that. So that will be explained also later on. So after discussing the VAT principles as well as the concept of the ecozone as a separate customs territory, let's now move on to the VAT registration requirements. So if you are a PESA entity, how would you register your company for VAT purposes? Of course, you will be registered for income tax, expanded withholding taxes, and other tax types. But how about for VAT? So let's discuss that. Okay, so for the VAT registration, it will now depend on the tax incentive that you are availing, either income tax holiday or 5% gross income tax. So if you are under the income tax holiday regime, so in effect, you are exempt from income tax. So for VAT purposes, you must register as a VAT taxpayer. So you have to file your VAT returns on a monthly and on a quarterly basis. You have to submit the list of sales, the list of summary list of purchases as a requirement under the relief program of the BIR. But if you are under the 5% gross income tax, and the 5% gross income tax, you are fully aware about this, that is in lieu of all taxes, including VAT. So therefore, if you are under the 5% gross income tax regime, therefore, you must register as a non-VAT taxpayer. So if you are graduating from the ITH regime, so you are supposedly under the VAT, you are registered as a VAT taxpayer, then you have to change your VAT registration from VAT to non-VAT if you are already graduating. Except, for example, even if you are under 5%, but you have local sales of service, so that's subject to VAT. If you have other unregistered activities with PESA, therefore, it will be subject to the regular taxes, including VAT. So you need to keep your registration as a VAT taxpayer if that is the case. Now let's move on to the specific treatment of certain transactions. Like for example, so these are the VAT transactions that you will encounter. So this is just a review. I know you know this, but let's try to review these principles. So first, we have this customs territory transactions. What is this? It's a transaction between a PEZA entity and a taxpayer in the customs territory. PEZA under foreign soil or under separate customs territory, and you are dealing with a taxpayer and inside in the customs territory or outside PEZA. Another type of transaction is intra-Ecozone transactions. So what is this? It's between transactions between PEZA registered enterprises. So you are selling your services to another PEZA entity, or you are buying services or goods from another PEZA entity. So that's what we call intra-Ecozone transactions. The third one is international transactions. From the word international, so basically from PEZA, it's a transaction between a PEZA entity to a non-resident supplier, basically outside the Philippines, no? So that's what we call international transactions. So let's now deal on the customs territory transactions, how we should treat these transactions, customs territory transactions. So what are the examples? Well, the first one would be if, for example, you are selling goods and property. So you're a PEZA entity, you're a seller, and your buyer is from the customs territory. So how would you deal the transaction? So you are the one selling. Should it be subject to VAT or not? So it is vatable, but because the concept now will come in a foreign soil, because in effect, the buyer is effectively buying this from a foreign territory. So in effect, it will be considered as a technical importation. So for example, for this type of transactions, in MEPS 1 or in MEPS 2, when a buyer buys goods from a PEZA company, so they will be the one supposedly paying the VAT and the duties. So they need to process this transaction. So it will pass through PEZA and through customs, and the corresponding VAT and duties will be paid. If you are the one selling services to a buyer, no, PEZA company, you are selling services to a buyer from the customs territory, it is subject to VAT at 12%. If you are the one buying, a PEZA company is the one buying goods from a customs territory. Okay, so the concept of a foreign soil, so effectively this is somehow considered as an export, technical export by that seller to a PEZA entity. So therefore subject to 0% VAT. In the same way, if you are buying services from a customs territory, it's also subject to VAT. But later on, Attorney Kim will discuss as regards to the update of these transactions. Okay. Purchase of goods from customs territory. So it's treated as an indirect export of customs territory seller, subject to 0% VAT, as I discussed earlier. But there are some exceptions. Like for example, if you are buying cars to be used for admin purposes, for example. So according to this Revenue Memorandum Circular 2599, no, it's issued in March 18, 1999. It should be subject to 12% VAT if you are buying this from Toyota, Mitsubishi, or other car distributors here in the Philippines, unless, for example, we had a previous client, their business is they are selling armored cars. So they are buying a finished product from a car distributor, and they put armor. No, they usually use this. The ones buying this is for very important persons, for example. So they need to put armor in the car so that if they will be shot, for example, naka-bulletproof siya. So if that is the case, then that will be zero rated because that is directly used in your business. Okay, purchase of services, if performed within the Ecozone, if the services were effectively performed inside the Ecozone, therefore it should be subject to 0%. Otherwise, it will be subject to 12% VAT. So what are the examples of this purchase of services that should be subjected to 12% VAT? So based on these rulings, one of the companies, a PESA company, is engaging a construction company, a construction to construct a building or a plant for its client, no? But that client is not a PESA company. So therefore, it is rendered to a non-PESA. It was performed not inside the Ecozone, but outside the Ecozone. Therefore, it was treated as a vatable transaction subject to 12%. During Christmas parties before the pandemic, so we usually have Christmas parties, anniversary of the company, and we held this in the hotel. Okay, so if you're a PESA company, you want to go to a hotel to celebrate these milestones of the company's Christmas parties or whatever. Based on this ruling, since the hotel services were performed outside the economic zone, therefore it should be subjected to 12% VAT. It is vatable, not subject to zero rating. So that's how you treat the purchase of services from customs territory by a PESA company. The other one is on indirect exports already subject to 12% VAT upon satisfaction of conditions under Republic Act number 10963, or what we call the train law, as implemented by Revenue Regulation 9-2021. I think this is the hot topic, the controversial issue, I think few months ago. And good thing the BIR issued a new regulation differing as regards to the implementation of this new revenue regulation. And that's the end of my presentation. Now, Attorney Kim will discuss on the updates about this issue. Thank you, Edel. Back to you.
Wow, thank you very much, Mr. Wendell Ganhinhin, for the very clear and comprehensive discussion. For the next part, we will delve and have a closer look on the VAT updates. Our second speaker is a senior manager of the Tax Advisory and Compliance Practice of PNA Grant Thornton. He is a lawyer and a certified public accountant. He is also a faculty member of the University of San Carlos College of Law, where he handles taxation and insurance subjects. He is as well a reviewer at the USC Accountancy Review Center. Currently, he sits as a member of the board and as a vice president for membership of the Philippine Institute of Certified Public Accountants CIB.O chapter. Additionally, he is a trustee and a finance committee head of CIB.O IT BPM organization. Please help me welcome our second speaker, Attorney Kim M. Aranas.
Thank you very much, Del, for that introduction. Good afternoon, everyone. And again, thank you very much for being with us this afternoon. So this time around, Sir Wendell already comprehensively discussed to us what value-added tax is all about. No? So because it is a consumption tax, so primarily we have to adhere to the cross-border doctrine or principle. And Sir Wendell also emphasized on the by fiction of law jurisdiction among Ecozone companies. So this time around, I will continue where Sir Wendell left off under Revenue Regulation 9-2021. So this is, again, as mentioned by Sir, this is a bit controversial. But just a quick backgrounder, why do we have this implementing rule? Why do we have this Revenue Regulation 9-2021? Primarily because of the provision under the train law. So there is this provision in the train law that took effect way back 2018, that if the enhanced VAT refund system is already in place, no? If these three conditions are already met, successful establishment and implementation of an enhanced VAT refund system, payment in cash of pending refunds, as well as establishments of VAT refund center, if this is determined to be in place already by the BIR and the DOF, then they will have to subject to VAT the transactions specifically identified under the train law. Now, because of that, the point of view of the BIR is they have sufficiently implemented the enhanced VAT refund system, although of course there are some parties who are trying to point out that that is a self-serving declaration. But nevertheless, because of this, according to the BIR, we already met the conditions. Therefore, the BIR issued RR 9-2021. So in this regulation, what is being provided is an enumeration or list of transactions which is already subject to 12% VAT. So this basically involves the purchases from customs territory, no, and pertaining to sale of raw materials or packaging materials to a non-resident buyer, to a resident, local-oriented enterprise to be used in manufacturing, processing, packing, or repacking in the Philippines. So take note of the qualifying qualifications here in the Philippines. It happens in the Philippines. In short, there was no actual export. Second, sale of materials or packaging materials to an export-oriented enterprise whose export sales exceed 70% of total annual production. And third, transactions considered export sales under EO 226. So this is more on the BOI registration. If you look at this, this pertains more to manufacturing, no, sale of goods or services. Where does IT BPM come into the picture? Of course, in the industry, we are more into sale of service, no? So what happens on this sale of service, especially to non-resident buyers? If you look at RR 9-2021, and this is a bit of good news to IT-BPM, it's not actually included in the enumeration per train law, and therefore it's not included in the revenue regulation. When it comes to sale of services and use or lease of properties, however, because we might be leasing these properties, the VAT 12% applies to these instances for processing, manufacturing, or repacking of goods for other persons doing business outside the Philippines. It's now subject to 12% VAT. And second, services performed by subcontractors and or contractors in processing, converting, or manufacturing goods for an enterprise whose export sales exceed 70%. Now, this regulation is controversial in the sense that we have to look at two things here, the sales as well as the purchase aspect, no? So when it comes to sales aspect for sale of services to non-resident buyers, say for example, it may be VAT 0 rated, but the purchase aspect thereon, the supplier of the IT company, let's say for example, which is PEZA registered, may already impose 12% VAT on the purchases. But when it comes to the sales, that's still 0%, subject to 0% VAT. Now, what happens therefore if we look at this specifically for number 3, transactions considered export sales under Executive Order number 226, that is the only express specification under the regulation. So if we look at that express provision, for these BOI registered entities, it should be subject to 12% VAT. Now, although, of course, BOI usually issues tax holiday incentives, it follows that it is already, the transaction is already VATable or subject to 12% VAT. Now, what if the company is registered under the PEZA law? No? So, apparently, if you look at RR 9-2021, the purchase of these services and use or lease of properties falls under services rendered to persons or entities whose exemption under special laws or international law agreement to which the Philippines is a signatory effectively subjects the supply of such services to 0% rate. So if you look at it, it could fall under this, which means that it would still be subject to 0% VAT when it comes to this purchase of services and use or lease of properties. However, this remains to be an aspect that is quite debatable insofar as the BIR is concerned. Point is, because of the possible effect of this regulation, wherein local suppliers and even subcontractors will now impose 12% VAT to manufacturing or export companies, whether registered with the PEZA or the BOI, whether they are exporting 70% or 100%. But at the same time, on their sales aspect, they will be imposing 0% VAT. It could lead to cash flow issue insofar as these companies is concerned. No? As promised in the create law, in the train law, let's talk about train law first. As promised in the train law and of course in the tax code, if ever there is excess input VAT, because of course the purchases there, if 12% VAT is imposed to you, to your purchases, that leads to input VAT, right? The 0% VAT for your sales, that's output. So you will have zero output. So ultimately, it will lead to excess input VAT. As provided under the law, Section 112 of the tax code, the taxpayer can claim refund, which is where the enhanced VAT refund system comes in, wherein under the train law, it's as if the government is promising that you will be refunded within a 90-day period. Theoretically. However, I should say theoretically, because in practice, it may very well go beyond 90 days, sometimes even years, no? Because of the audit, the mandatory audit involved in the claim for refund. So it raised a cash flow issue insofar as the affected companies are concerned. So that's one. They lobbied for that. Second, they question, of course, the basis of the DOF and the BIR in saying that this is already timely or that they've met already the conditions laid out under the train law. Those who question it basically are saying that it is self-serving. And the third basis in questioning this regulation is the very provision under CREATE. Take note, RR9 is not based on the CREATE law. It's based on the train law. In the CREATE law, when it was passed after several years of deliberation, when it took effect April 11, there is already an inserted provision that VAT exemption on importation and VAT zero rating will remain if it pertains to purchases of services or goods which are directly and exclusively used for the registered activity of a registered business enterprise. So that alone contradicts, the very provision under Revenue Regulation 9-2021, because 9-2021 is saying that your purchases is now VATable. But CREATE is saying it can still be VAT zero rated provided it is directly and exclusively used for your registered business activity. Because of that, and because of the lobby of various sectors, the BIR or the DOF, should I say, was forced to issue Revenue Regulation 9-2021, which differs the implementation of Revenue Regulation 9-2021 on the imposition of the 12% VAT on the transactions that I have mentioned a while ago. Okay, we have to be careful because it merely says defers the implementation. So that alone tells us that there really is an intent to implement that provision, because after all, that is a provision under the trade law. So now currently there is already, it's already circulated by the BIR for comments. There is already a draft revenue regulation which seeks, of course, to implement that provision in the train law. But looking at the revenue regulation, they crafted it quite different from RR9-2021 in the sense that they did not anymore list the transactions that are already VATable or that are already subject to 12% VAT. Instead, what the draft provide is just a revision on the definition of export sales, no? Which is still subject to 0% VAT. And in the enumerated items or in the enumeration, there are just some transactions that are taken off the very definition itself, right? So as what I've mentioned in that proposed RR on VAT, I think that's available on the BIR website if you want. The sales to the export sales wherein VAT zero rating could still be availed indicates that if it pertains to sales to persons exempted from direct and indirect taxes under special laws. So there is this added provision therein. And when it comes to sale of raw materials, inventories, as well as services, the said draft RR now adhered to the provision under CREATE that it would still be zero rated and the importation would still be VAT exempt, provided it is used directly and exclusively in its registered project or activity pursuant to section 294 and 295 of the tax code. So therefore, what is clear insofar as these recent regulations is concerned, what is clear now is the CREATE law is already effective. And what is clear is that under the CREATE law, it expressly provides that there would still be VAT zero rating on these purchases of goods, properties, or services, provided it is directly and exclusively related in the registered project or activity of the registered business enterprise. So I think this is the more crucial thing now that we have to understand, no? If we don't want our suppliers to charge us 12% VAT, which will just end up, accumulating, wherein you will have very high input over output. Because the option there supposedly as provided under the CREATE is that since 12% VAT will be passed on to you by your supplier, you basically have two options, either to claim for refund or tax credit. But claiming it as tax credit would be useless, again, if you have zero output, right? So ultimately, your input will just accumulate and ultimately you will seek for refund, if only to recover the VAT portion of, of the supplies, no, that was charged to you by your suppliers. So that's when proper communication and understanding comes in. And hopefully the BIR will issue revenue memorandum circular clarifying what is directly and exclusively means as provided under the law and under the regulation. However, there are already clues that we can take under the IRR of the CREATE, and we will discuss that one later on. There is already an enumeration as to what are considered direct costs or expenses in the computation of the gross income, where the 5% preferential rate will be based upon. So that could give us an idea what is meant by by these purchases of course or service directly and exclusively related to the registered project or activity. Okay. So this is what I've been mentioning a while ago, VAT zero rating incentive for registered enterprises. So this is section 5. It provides that VAT exemption on importation and VAT zero rating on local purchases shall only apply to goods and services directly and exclusively used in the registered project or activity with a concerned IPA. So this is already effective, no? Effective April 11 this year or 2021. Now you might ask, what's the reason behind why those transactions that I've mentioned a while back is under the train law being subjected to 12% VAT. Now I can still vividly recall the explanation of the legislator when Sir Wendell and I attended a forum. Their explanation to that is due to, well, of course, there's some other factors, but primarily the government noted that the VAT zero rating provision or incentive has been abused. No, so they've noted, that's why if you notice, they're more focused on the manufacturing, the processing, no, of raw materials, because they noted there are some companies which has affiliates or sister companies, so to speak, which are located within the economic zone and outside the economic zone. So, just to avoid VAT, the government noted that the importation, say for example, is coursed through the economic zone, so that it will be VAT zero rated, but then eventually it will go to the customs territory, because after all, they are just the same company, or they belong to the same owner. So because of that, the proposal was to VAT everything, not to VAT everything. That's why they enumerated, they remove the VAT zero rating on those so-called constructive exports. Because if you look at those transactions that I've enumerated, there was actually no actual export. So that's what we call as effective VAT zero rating, not the actual VAT zero rating following the the cross-border doctrine. So the point of view there of the government is that it's effectively zero rated pursuant to the provision of the law. And because it's a provision, because that incentive is provided under the law, it can very well be taken off. It can very well be taken away by passing an amendatory law, which is what they did when they passed the train law. Which is why, if you look at it, those transactions were removed under the definition of VAT zero rated sales of pertaining to goods or properties or sale of service. But under CREATE, because of the deliberations and the lobbying, the legislators medyo hindi sad ni atras, but medyo ni give way, no? ni consider sa sentiments of the legitimate actual exporters. Because of course, if you will subject to VAT everything, especially on the purchases, the one who will also suffer are also the 100% exporters who are compliant with the with the rules and regulations. So they have to take their sentiments into consideration. So because of that, they included Section 5, no? So which states that so long as it's directly and exclusively used in the registered project or activity, then it will be VAT zero rated still. There should be no 12% VAT passed on to you by your supplier. Okay, so the question now is, what is meant by this direct and exclusive use? So if we look at the IRR, if we look at the CREATE law itself, there is already this clue, although I should say this is a bit vague pa, but at least we will have an idea that when we say direct and exclusive use in the registered project or activity, this of course refers to the raw materials, inventories, supplies, equipment, goods, services, and other expenditures necessary for the registered project or activity, without which the registered project or activity cannot be carried out. Keywords there is necessary, and of course the phrase without which the registered project or activity cannot be carried out or cannot be completed. Because if you just look at the enumeration, it's still sort of subject to interpretation, no? Inventory, supplies, equipment, what's the composition of this? If you want to have some sort of an idea as to what are considered direct costs and expenses, we can refer to the IRR, the implementing rules of CREATE, section 2 in the IRR, which discusses the computation of gross income to be multiplied to the 5% preferential rate, already made an exclusive enumeration as to what are considered direct costs and expenses. No? So most likely that could be used as basis by the BIR when it comes to the interpretation of the cost or expenses directly and exclusively used. No? So among the enumerated items in the IRR are, of course, the salaries and wages of the employees, the direct labor for for manufacturing. No? Specific enumeration as to the items are also provided therein. So how to determine if the goods or services are directly and exclusively used in the registered activities? Prior to CREATE, not much of a problem on this, because all we need to do is to get a VAT zero rating certificate from PEZA, or get a certification from BOI, declaring that this purchase is subject to 0% VAT, and you just give that or present that to your supplier. But now, it might not be that case anymore, no? What we pertaining to this issue, what we have to take into consideration lang, based on regulations as well as decisions of the Supreme Court, is that when it comes to VAT zero rating of local purchases, we have to take into consideration the cross-border doctrine that was explained by Sir Wendell a while back, no? Wherein under that cross-border doctrine, ecozones are deemed, or by fiction of law, foreign territories, which is why if you want to avail of these incentives, it is very crucial that you have to locate in a PEZA registered building, or in an ecozone, so to speak. In prior cases decided, the Supreme Court already affirmed the previous issuances of the BIR by saying that any sale by a VAT-registered supplier from the customs territory to a PEZA-registered enterprise shall be considered an export sale and subject to 0% VAT. All sales of goods, properties, and services made by a VAT-registered supplier from the customs territory to an Ecozone enterprise shall be subject to 0% VAT, regardless of the latter's type or class of PEZA registration. Take note, however, these were decided prior to the CREATE law, no? Prior to the CREATE law. So if you look at the basis, it's RMCs issued way back 1999. Now, it could be an entirely different ball game, considering the direct and exclusive use qualification as provided under the CREATE law. We also have this Coral Bay Nickel Corp case, wherein the Supreme Court declared that PEZA registered enterprises which would necessarily be located within ecozones are at the very least VAT exempt entities, because of Section 8 of the law, which establishes the fiction that ecozones are foreign territory. Actually, to those who are trying to lobby during train, prior to the CREATE law, these cases were cited in several position papers, no? The by fiction of law foreign territory, and that as a result, sales made by a supplier to the customs territory to a purchaser in the ecozone should be considered as exportation from the customs territory, no? So they've raised this. However, when the CREATE law was passed and finalized, what was considered are only those actually and directly related, which somehow is quite reasonable already. No, so because again of the cross-border doctrine or principle. So what happens now if so I hope you are clear on that. No? It has to be direct and exclusively used. Now, point is, there are purchases either of goods or services which is indirect, no, or not directly related to the registered business activity. So what happens now is that your supplier will of course be charging you 12% VAT, but we have to check if that supplier in the first place is VAT registered, no? And that supplier must be able to issue, VAT official receipts or VAT sales invoice, as the case may be, because that is our primary proof if we're going to claim it as expense, or if you determine that it's direct, you want to claim refund, primarily that's what you're going to present to the BIR. The purchases, it entails input VAT. That's the 12% VAT passed on to you by your supplier. So for the input VAT from local purchases of Ecozone entity, what's the treatment? Prior to CREATE, or before the CREATE law, purchases of goods and services by Ecozone entity that were destined for consumption within the Ecozone should be free of VAT, right? In case VAT is passed on and paid by the Ecozone entity, the VAT may not be a subject of claim for refund. Instead, the proper recourse was not against the government, but against the seller who shifted the VAT to somebody located in the Ecozone. That's prior to the CREATE law. Now, under CREATE, what happens is that there is a change, of course, no? Because again, only those directly related and exclusively used will, have VAT 0 rating. So the rest, it will be VATable. So in such case, create a revenue regulation or implementing rules provides that if there is excess input taxes attributable to zero-rated sales by VAT registered business enterprises may, at the registered business enterprises option, be refunded or applied for a tax credit, subject to the guidelines provided under Revenue Regulations number 13-2018 as amended. So what does this RR 13-2018 tells us when it comes to claims for refund or tax credit? This revenue regulation provides that a VAT registered person whose sales of goods, properties, or services are zero rated or effectively zero rated may apply for the issuance of a tax refund of input tax attributable to such sales within 2 years after the close of the taxable quarter when such sales were made. So kana pa lang, there is a period to claim the refund. No? Otherwise, your only option would be to claim the input VAT passed on to you as part of your costs or expenses. You cannot be refunded peso for peso. This is under Section 112 of the NIRC, and this is where the enhanced VAT refund system comes in, which requires that within 90 days, the CIR or his authorized representative should be able to provide the refund. So this is the issue that I've raised a while back that could create cash flow issue, especially if there is no VATable sales, that could generate output VAT where the input VAT could just be credited. Because if that will happen, that would be good. That would be good because you will just credit it. You don't have to undergo the refund processes. So if you are purely VAT zero rated sales, your output will be zero, but you will have high input which will accumulate over several periods in time. And in that case, your only option will only be refund. And Section 112 is our guideline there. Of course, there are revenue memorandum circulars issued by the BIR as to what are the documentary requirements in case companies or registered business enterprises will claim for refund. So where to file the refund? Of course, as clarified under the CREATE law, it will be filed in the RDO or the LTDO having jurisdiction over the principal place of business of the taxpayer, and claims for input tax refund of direct exporters shall be exclusively filed with the VAT Credit Audit Division or VCAD. What do we mean by direct exporters? So these are the exporters, as what I've mentioned, whose sales is VAT zero rated, whose sales is VAT zero rated, but they have supplies that is already being subjected to VAT, maybe because it is indirect in the first place. The refund, the enhanced VAT refund system, must be granted for creditable input taxes within 90 days from the date of submission of the official receipts or invoices and other documents in support of the application. Now, let's be clear on this refund. Please take note that the input VAT refund applies only to a zero-rated sale or an effectively zero-rated sales transaction, which means that the taxpayer at the onset must be VAT registered. Because even if you are into export, let's say for example, but you're not VAT registered at the very start, then the least VAT exempt lang ka. So in that case, if the input VAT pertains to a VAT exempt sale, you cannot claim VAT refund peso for peso under Section 112. So what will happen naman, Kim, when it comes to those, to the input VAT in relation to those VAT exempt sale? While you may not claim it, claim for refund on that, you can still claim it as what? You can still claim it as part of your cost or expenses, as part of your cost or expenses. But if you look at it, medyo alkansi na, because the tax savings there is 20% or 25% na lang, unlike in a refund where you will be given a peso for peso return, of what you paid for VAT to your supplier. Okay. So what happens now when it comes to intra-Ecozone transactions? These are transactions between PEZA registered enterprises or PEZA registered companies. This is common among manufacturing companies within PEZA, no? So there are locators in the Ecozone wherein their mode of or business model is to provide raw material for another PEZA registered company who does the actual export abroad. So what happens in these intra-Ecozone transactions? Of course, when it comes to sale of goods or property to another Ecozone enterprise, it is exempt. It is exempted from VAT. No? So there is no VAT on sale. There is also no VAT on the purchase. When it comes, however, to sale of service to another Ecozone enterprise, we have to look if the seller is under the 5% gross income tax preferential rate. So in that case, it will be exempt from VAT. If the seller does not enjoy the 5% gross income tax or income tax holiday, then in such case, it may be subject to the 0% VAT. For international transactions, this was mentioned also by Sir Wendell a while ago. This is the actual export, no, or actual import, as the case may be, between PEZA registered enterprises and non-resident supplier and buyer of goods and services, which is applicable to IT BPM companies. What's the rule when it comes to importation of goods? Generally, it is exempt from VAT. Why do we say generally? Because of course, these goods must be, as provided under the tax code, the imported goods must be actually and directly and exclusively used, or directly and exclusively used, no, for the registered business activity of the registered business enterprise. If it's found out that it is not actually direct, that it is not directly and exclusively used, then it might be subjected to the usual 12% VAT. Although usually, this usually pertains to kuanman, diba? Raw materials, no? Which is why automatic it's exempted from VAT. So again, when it comes to importation of goods, is it still exempt from VAT? Because it was the major concern of several entities when RR 9-2021 was passed. So we have to remember at this point that under CREATE, it is still VAT exempt, but it must be directly and exclusively used in the registered project or activity of the export enterprise. So that's the qualification that we have to always bear in mind, all right, for it to be exempted from VAT. Purchase of services from non-residents, of course, it will be exempt from VAT when it comes to international transactions. Exports, sales, if VAT registered, then subject to 0% VAT. And you can very well claim, this is what I've meant a while back when we say refund of input VAT. So you can claim for refund. If non-VAT registered, then it will be VAT exempt under Section 109 of the tax code as a rule. Okay, so basically those are the updates in relation to value-added tax. Insofar as the regulation and the memorandum circular is concerned, no? So at this point, let's just look at some important jurisprudences, which you may find helpful in relation to value-added tax, either on sales or on purchases. So first off, we have this 2020 case of CIR versus Deutsche Knowledge Ltd. This is an ROHQ, a regional operating headquarter. So basically, Deutsche is trying to claim for a refund on excess input VAT pertaining to an effectively zero-rated sale. So Deutsche is, of course, into sale of service, similar to most IT BPM companies here. So its client is foreign, based abroad. No? Because of that, its output is zero, its output VAT, but its suppliers are charging 12% VAT. So its input is higher than its output. So it led to a refundable amount. Now, in this case, the CIR actually disallowed the claim for refund by Deutsche. No, the CAR claims that Deutsche, you failed to submit proof of submission of monthly VAT returns or monthly VAT declarations. No? As the CIR also pointed out that you failed to keep and preserve your books within the period as required under the law. And because of this, mga if we have to, if you have to simplify that, it's more like of an open case. So the BIR is like saying, because of these open cases, violations, your claim for refund should not be granted. No, so they went up until the Supreme Court, and the Supreme Court made it clear that under the tax code, the conditions for zero rating of sale of services, tulo lang. There are only 3 conditions laid out under the law. And again, this is not changed under either train or create law. So it's still the same when it comes to sale of service to non-residents. No? So the Supreme Court said 3 requisites lang. 1, the seller must be VAT registered for it to be VAT subject to 0% VAT. 2, the services are rendered to a person engaged in business conducted outside the Philippines or to a non-resident person not engaged in business who is outside the Philippines when the services are performed. That's the second condition. And third, it must be paid for in acceptable foreign currency and accounted for in accordance with the BSP rules. So the Supreme Court said these are the only conditions. So if these conditions are met, then that is a zero-rated sale of service. No, you cannot base the denial of the refund on some other external factors, say for example the failure to submit this return and that return, because of course at the end of the day we very well know, diba, the taxpayer can be just penalized on that. No, there is what we call as a compromise penalty that will have to be paid by the taxpayer, and in such case, when there is already compromise penalty, that should already be a settled issue. So the CIR further questioned, in this case, that Deutsche, you failed to present proof that you are rendering service to non-resident persons or to those engaged in business outside the Philippines. However, unfortunately for the CIR, it was already found out at the CTA level that the Deutsche, in this case, already presented proof of NRFC status of its clients, okay? Which is why the Supreme Court reiterated that when it comes to proof of non-residency of the client of Deutsche, 2 things. And of course, we have to remember this, especially because IT BPM, we are rendering service, not to foreign clients. 2 things must be made. Place of incorporation or establishment of the client must, of course, be outside of the Philippines, not here, because otherwise it becomes a domestic entity. And it must not be engaged in trade or business in the Philippines. This is a 2-pronged requirement. So meaning to say, if you're only going to present proof that the place of incorporation is abroad, but you will not present proof that that entity is not engaged in trade or business in the Philippines, then you failed to provide sufficient proof of NRFC status. No? And that's what happened in the Accenture case and I think Cital case, where they only submitted proof of incorporation of their clients, but no proof that their clients are not engaged in trade or business in the Philippines. So in this case, what proofs were presented by Deutsche that we could, bear in mind? To prove the place of incorporation or establishment of its clients, authenticated articles of association or incorporation were presented by Deutsche because it is a regional operating headquarter. And usually, if you're a regional operating headquarter, in your license, the SEC will specify there in the first place that you are to serve only international market or international clients. No? So in that case, there is already some sort of master list insofar as this ROHQ is concerned. Similar also to IT BPM, check your articles of incorporation because there might be a limitation there that you are only going to provide, that you're an export service enterprise. In short, you're going to provide service in the international market or international clients. So that should be part of your discussion, especially if management wants to go local. No, so because there might be a limitation on that aspect. So other than the authenticated articles of association, the ROHQ also presented SEC certification of non-registration of the company. So this certification, we can get this from SEC, wherein SEC will detail that, this company is not registered here in the Philippines and it does not have license to do business here in the Philippines. So that alone tells us that it is not engaged in trade or business in the Philippines. No, otherwise, it's if they have presence here in the Philippines and the SEC certification says that they're not registered, then that is an illegal, an illegal act, or that is already a different story. All right, so this is one thing that we can take into consideration, especially pertaining to our VAT zero-rated sale, because this usually comes out as an issue per our experience when it comes to BIR assessments. Pertaining specifically to IT BPM companies. No? By the way, part of our proposal also with CIB.O is to do another lecture series pertaining to tax assessments, because as we very well know, the BIR is the government in general. No? The government needs funds, and the BIR is quite active now in issuing LOAs. So as taxpayers, we have to be well equipped on the basics or foundations of these assessments. So as what I've mentioned, this is a common finding, because if it's found out that, in your filings, you treat it as VAT zero-rated sale, but in the first place, you failed to comply the 3 requisites under Section 108, you may have the, you may say that your clients are non-residents, but it's not accounted for properly. No, it's not paid for in foreign currency, because when it came here, it's already converted to Philippine peso. You're already paid in Philippine peso. That could present already a very big tax exposure, both income tax as well as value-added tax. So at least if the question is more on your clientele, then our guide is the proof of NRFC status as settled in this particular case. Okay. Another important case, very recent, last year, November 23, 2020. This is the CAR versus Felix Mining Corporation. This is to further discuss on the topic a while back, wherein we said that if you are into VAT zero-rated sale, or effectively VAT zero-rated sale, and your input tax is higher than your output tax, you can actually claim the difference for refund. So here, the Supreme Court laid down the requisites in claim for refunds under Section 112. The Supreme Court made it clear that for you to claim that refund, number one, you must be a VAT registered taxpayer. Number two, you must be engaged in zero-rated or effectively zero-rated sale. Number three, claim is filed within 2 years after the close of the taxable quarter when the sales were made. So we have to take note on that. Our tax compliance team should be well aware when the sales were made and when the claim for refund will have to be filed. Creditable input tax is attributable to such sales, and it's paid in acceptable foreign currency exchange, which is duly accounted for. So in this case, the Supreme Court made emphasis on the supporting documents that we are going to present if we are going to claim for refund. So if it pertains to importation, it must be duly supported by import entry declaration or its equivalent, because the import entry declaration will provide there a detail in case VAT was imposed during the importation. No? Or if it is a domestic purchase of service, we have to present the VAT official receipt. So this is what I've mentioned a while ago, in case your supplier will impose 12% VAT to you, you can very well claim refund. But you have to make sure VAT OR was issued by your supplier. So the Supreme Court mismo made it clear that these informations enumerated here should be disclosed or present in the official receipt. Although, of course, the Supreme Court merely emphasized this, but this is required also in the BIR circulars and regulations. So there must be, the seller must be VAT registered. Of course, the name of the seller must be indicated in the OR. The TIN of the seller must be indicated. The word zero rated sale must be printed clearly. The date of transaction, the nature, the business style, as well as the address of the purchaser must be completely indicated in the receipt. And of course, the TIN of the purchaser must be indicated. In the absence of any of this information, especially the word zero rated sale there, it can be a ground for disallowance of your claim for refund. No, because again, when it comes to sale, it could be zero rated sale, it could be vatable sale, it could be VAT exempt sale. No, of course, if it is a VAT exempt sales transaction, VAT exempt sales transaction, you cannot claim for refund. So if it is not clearly indicated zero rated, it could in the first place be an issue. No, which could lead to denial of your claim. Okay, so I think these are the two relevant jurisprudences insofar as value-added taxation is concerned. We just ended in time, and I think that's my part in the updating when it comes to value-added taxation. Thank you very much for your time, and we hope that you get something out of this discussion. No? In the interest of time, feel free to contact us in case you have any questions or clarifications other than the questions that we might be able to address during the open forum. So at this point, I'd like to turn you over to our moderator, Ms. Edel Ocanyada. Del?
Hi, Sir Kim. Thank you so much, sir, for that intelligible and unswerving talk. The last part of this afternoon's event is the open forum. To our dear speakers, we kindly request you to open your camera for this part. And to all our participants, you may feel free to raise your questions to our speakers. Please feel free to make use of the chat box to type in your questions.
I think we already have some questions there from the registered participants.
Okay, sir. We have received advanced questions from our participants during their registration. Allow me to read them for you. The first question is, should we ask vendors to issue separate invoices for VAT zero rated goods or services that will be directly and exclusively used in the registered activities as RBE, and 12% VAT portion or a simple breakdown in the one invoice will follow?
Okay. So, Sir Wendell, should I would it be
You
all right?
answer first, Kim, and then I will add.
So
It's a very interesting question, actually.
This is a very interesting question, considering again on the confusion somehow on the imposition of the 12% VAT. Well, given our discussion a while back on the provisions in the create that still VAT zero rated are the purchases which are directly and exclusively related to the registered business activity, we can say that you can actually, it can separately indicate the vatable as well as the zero rated portion if it is being done in one transaction. What we can refer to here is section 113 of the tax code, wherein there should be proper separation of the or classification of the sales. Sir Wendell, if you have additional input, sir.
Yeah, because what is critical here is the clarification as regards to what is directly and exclusively used for the registered activity of the company. Uh, because if that can be defined, if we will base it based on the definition of or direct cost, for example, then it would be easy. But even if using that one, even if using that definition, okay, uh, the issue would now be on the specifics. For example, okay, I will just no, share some specifics. For example, as regards to your rental is part of it is used for the production or for uh, your call center operations, and part of it for the support services. For the support services, supposedly it should not be part of your direct cost. Okay, so in effect, you have to identify now, okay, lessor, this part is not subject, is directly used for the registered activity, if that's how we define it. And then the other part is, this is for indirect use. Therefore, it should be vatable. So supposedly that's how you know, and okay, that's for rental. How about supplies? So supplies is, you cannot determine it when you buy your supplies, office supplies. You don't know yet unless you segregate that one. If, for example, it's centralized supplies and it's based on consumption. So by the time that you buy the office supplies, you don't know yet if it will be consumed for your operations, direct operations, or for the support operations. So that's basically the dilemma right now. So that's why I think the PICPA, ACPAP, the Association of Certified Public Accountants in Public Practice, submitted a position paper to the BIR, to the DOF, that if it's a PESA company with just one registered activity, it's 100% export sales, then supposedly same concept, no? It's if that company, PESA company, will be buying goods and services, it can be part of direct cost or indirect operating expenses. Supposedly, it should be treated as zero-rated sale. So again, as I said earlier, very critical is how the BIR define what is exclusively and directly used for the registered activity. That's my opinion, Kim. But if for some, if you want to be conservative, so you can start segregating that one, no? The invoices for the zero-rated transactions and separate invoices for the non transactions that will not be classified based on our understanding that it's not part of the direct cost. Or it can be combined, no? Because in the VAT invoice, for example, it can be combined. No? There's a vatable, there's a zero-rated. So you just have to segregate that in one invoice. So it can be done that way also.
Okay, thank you, Sandal. For the second question, I think this is for Attorney Kim. Definition of direct and exclusive use in the registered activities to be eligible for VAT zero rating.
Okay. All right. So for the definition, again, we can refer to section 5 of the IRR of the CREATE law. Definition-wise, it simply mentioned here that the direct and exclusive use in the registered project or activity refers to raw materials, inventories, supplies, equipment, goods, services, and other expenditures necessary for the registered project or activity, without which the registered project or activity cannot be carried out. So that's the definition, which I know you will agree with me is quite vague. Especially when we go to the details of, what's the composition of this inventory, what's the composition of these services, which is why, as I've mentioned a while back, while there is a an enumeration as to what are considered direct costs and expenses in the computation of the gross income, which will be multiplied to the 5% under the IRR, still, I don't think that would be enough, no? And that's where the jurisprudences could come in, and actual questions before the Supreme Court could come in, similar to what happened prior to CREATE. Because if you notice, prior to CREATE, there were also enumerations as to what can be claimed as expenses, but ultimately the Supreme Court said that it is not exclusive. Different, however, in CREATE, when it comes to deductions to compute the gross income, there is already an express provision limited only to the following. But then again, as mentioned by Sir Wendell, although it's mentioned there, the specifics is quite different depending on the operation and the industry of the registered business enterprise. So yeah, so I think there is the theoretical aspect as well as the practical aspect. So theory-wise, it's easy to define, but practicality, it might be quite challenging. Sir Wendell?
I agree with you, Kim. That's correct.
Yes. And yeah, if I recall, there were many cases no, involving IT BPM, just on the, not cases reaching the Supreme Court, but also rulings, because of the sir, because of this unique costs or expenses involved on a particular project or a business activity. To be conservative, many IT BPMs would either ask for a ruling, and even it even becomes Supreme Court cases, jurisprudences, just because it is not expressly listed in the regulation.
Yeah, in that ruling, because we obtained several rulings about that. So we specified, for example, that okay, for rental, for example, you have to do the allocation. For other services, you have to allocate that. So there's a basis of how you allocate the cost. That is, this is part of the rec, and this is indirect or part of the operating expenses. So if we will use that for VAT purposes, it should be the same. But for some cases, maybe for supplies, so the best way to do it is, okay, I will segregate these supplies that I will purchase, for example, for the rec, for this operation, call center operations. This is to be used for the admin support services. So by the time that you buy that, for example, you know that, okay, this is intended for this is intended, so this is vatable, this is zero rated. Something like that.
Okay. For our third question, sirs, when we say goods and services directly and exclusively used in the registered project or activity, is this the same direct costs that are deducted to gross sales or gross receipts to arrive at the GIT subject to the 5% special rate?
Okay. I just checked the IRR. We cannot, we cannot really say that it's the same, because if we look at the section on the computation of the gross income for the special preferential rate, it's expressly stated there, the direct costs and expenses. No, for the computation, let me just cite the specific heading here. This one. So only the following shall be considered as direct costs for purposes of computing the gross income earned to be imposed the 5% special corporate income tax rate. So insofar as the IRR is concerned, it is expressly stated only for the computation thereof. So that's my offhand opinion as of now, because if we interpret that the enumerated item there are also the very composition of the direct and exclusive qualification, then we are already boxing the interpretation. I don't know if Sir Wendell has a different view on that. Sir Wendell?
Yeah, I agree with you, Kim. I agree with your opinion as of now, no? In the absence of any other issuances by the BIR.
So hopefully that will also be contained in an RMC, no, to be issued later on by the bureau.
Yeah.
Yeah, because prior to create, there were several RMCs actually issued by the BIR in relation to that. Del, I think there are questions also in the chat box.
Yes, sir. For the fourth question, sir, will the exclusive list of expenses per IRR be applicable only to new projects registered under Create? Accordingly, existing registration will still enjoy the SC decision on non-exclusivity of direct costs pre-Create.
Kim, can you answer initially?
I think this is a good point. So will the exclusive list of expenses per IRR be applicable only to the new projects registered under Create? I think I don't know, but offhand, because again everything has to be implemented by the BIR. But I think we have to check here when we are trying to claim the cost or the incentive or the benefit. Because of course, if we are trying to claim that during the effectivity of Create, then the BIR might be of the view that we have to follow the provisions under Create. On the other hand, if it pertains to prior years pre-Create, prior to the effectivity of Create, then definitely it's a non-issue. The Supreme Court decision on the non-exclusivity of direct costs should be applicable. No, I'm just looking at the point of view of the BIR, because assessments for 2020, say for example, Create is not yet there. So by all means, it should, to be fair, the decisions in those Supreme Court cases should be followed, because those decisions were based on laws, regulations, and RMCs prior to Create, which was effective back then. But if we are claiming something now, wherein Create is already effective, it might be a different ball game. Sir?
Yeah, that's a very good question because I think there's some discrepancies, some differences as regards to the listing of deductions under Create and the previous one. No? So uh, which should be followed as regards to the list of deductions. So it will depend on the timing as you discussed, Kim, and I would suppose because you have to follow the deductions under Create. That's also my initial take on that issue.
Yes.
All
I
right.
think to sorry, Del. I think to further that discussion, we have to also consider, especially those who are into PESA, into 5% special rate now. We have to take into consideration the transitory provisions under the Create, no? That basically now under Create, we are given 10 years to continue with that incentive. So most likely, because we're trying to claim now an incentive provided under Create, most likely the BIR will also or might also apply the provisions under the Create law.
But that's very very good question raised.
Yes, correct.
Yeah.
Correct.
And it will be good also if to compare the deductions under Create and the deductions under the old PESA law. So what are the differences? So we can check also how it should be, most likely the treatment of the BIR.
Correct.
Yep.
I think the team will note this concern from Sir Michael, no, and perhaps we can raise this also. So once and for all, this can be clarified, if not by the PESA, by the BIR, or by the DOF.
Right. I agree.
As for the fifth question, sirs, the first, it is comprised of two questions. The first question would be, if expense is not directly related to the registered activity, but it's a service performed in the Ecozone, both are PESA registered actually, can the company file for a VAT refund?
sorry, what was that, Del? If the service is
If the service is for a while, sir. For question A, sir, if expense is not directly related to the registered activity, but it's a service performed in the Ecozone, both as a registered, can the company file for a VAT refund?
so it is a sorry, so it is an intrazone. It is an intrazone transaction. Am I right?
Right.
So
Indirect.
within PESA, but indirect. So the question now is if the company can claim for refund.
Yeah.
Okay. So I think our primary reference there, Sir Wendell, is section 112
Okay.
of the tax code, sir, no?
Yep. Yep.
Because if we look at section 112, as discussed a while back, the only qualification there is that the input VAT should pertain to a zero-rated sale
Yes.
or an effectively zero-rated sale, so you are qualified to claim for refund. That if we look at 112, that's already present prior to create, which establishes the direct and exclusive use requirement. So I think so long as we can meet those conditions as discussed a while back.
So if you are 100% exporter, then supposedly you can apply for refund because applying the directly, if it should be directly and exclusively used. If that is not directly used, then to be conservative, it should be subjected to VAT. So, and if you are exporting 100% of your sales, do you have the basis of claiming for VAT refund of that input VAT?
Yes. So long as you don't have, VAT exempt sales or
Yeah.
things. Um,
Okay.
Thank you,
Sir.
Del. Back to you, Del.
The next question, sir, is connected to the first question actually. If the service is from a local supplier, but to company in the Ecozone, can the company file for a VAT refund?
uh, how should we put this? I think no matter, I don't know, but I think we addressed a while back, Del, the provision under section 112. But of course, we have to have a caveat here, I think, no, because ultimately the details there, the supporting documents there will have to be evaluated by the BIR at the end of the day. But if we just look at that provision as what was mentioned a while back, if it pertains to your if it's related to your zero-rated sale or effectively zero-rated sale, then you can apply under section 112.
I agree.
Okay. Others, can we still cater to more questions?
Yeah, I think there's still questions in the chat box. 2 questions remaining.
Yeah, there is a good question from Alliance Inc. Actually, Del.
Okay. From Alliance Inc., sir, when you say 10 years attorney, when will it start? Most of us started at ITH, then 3 years or 5 years later, we transitioned to 5%.
Yeah, this is a good question because, and this was my topic in the webinar this morning, because under the CREATE, permit Mr. Wendell to just take this, under the CREATE law in the revenue regulation for the fiscal incentives, no, in the transitory provision, if an existing registered business enterprise is currently enjoying only income tax holiday, then you're permitted to continue until the end of that income tax holiday. The second situation is if you are currently enjoying income tax holiday and thereafter you're allowed to for the 5% preferential rate, then you are allowed to finish the period of the tax holiday and continue with the 5% preferential rate, but good only for 10 years for both. So if the remaining time for tax holiday, let's say for example, is 2 years, So you basically have 8 years based on the RR to finish the 10-year period limit for both incentives. The third situation is if the company is currently enjoying 5% preferential rate, which I think is the subject of this question, because the ITH started already, then 3 years or 5 years later we transitioned to 5%. So I presume currently you are already availing the 5%. So based on the transitory provision under CREATE, you have 10 years to enjoy that 5% from the effectivity of the CREATE law. So when we say 10 years from effectivity, then we count beginning April 11 or April 12, 2021, 10 years thereafter. So I hope I've
Okay.
answered that. Thank you.
For the last question, sir, from Sir Don Dale Bacalso, I would like, okay, can you expound more 5% special rate since my corporation is graduating from ITR? It would really help us. Thank you.
I think this is ITH, siguro, no?
Yep.
Graduating from ITH.
Yep.
Yes, sir.
Yes. Sir, you want to take the lead?
Okay, sige. So you want that we will expound what will happen if you are under 5%, no? So under the 5%, so basically the 5% will be based on your gross income or the gross profit. So basically sales less direct cost. So what is critical in computing your 5% is what is the definition of your direct cost. So it will depend on the type of service or product. So you have to identify. So for a call center, perhaps, of course, salaries and wages, rental, depreciation of your computers, maybe software used, for example, used for the operation. So these are your direct costs, which you can claim in computing the gross profit times the 5%. So that's basically the how you do it in computing the 5%. Maybe Kim, you can add something.
Yeah. I think my only addition there, sir, is because Sir Don asked that they're going to graduate from ITH. So I suppose they are PEZA registered. So just check, sir, on the registration agreement, PEZA registration agreement, because there are some conditions there that you also need to comply, reports that you need to comply before PEZA. And it must be expressly provided in that certification that you're granted the ITH and of course the 5% special rate in lieu of all other taxes. I think kana lang, sir. And then of course the transitory period under the CREATE law or the CREATE Act.
Right, I agree.
Okay. I think there are no more questions from the chat box, sir. For any other inquiries, including the complicated ones, you can always tap us using the contact details provided earlier. Okay. Before we proceed to our closing remarks, we would like to request for a photo opportunity to our virtual participants in the call. May I request everyone to please open your camera for a quick photo op?
For documentation purposes. Mike, I think Mike can facilitate. Gallery view to Mike.
Thank you all for attending this webinar. Hope to see you again in our next webinar with CIB.O.
Mike, give us the signal, Mike. Or sa ba?
Yes, sir. Okay, is everyone ready?
Pwede pa mo habol.
Pwede pa mo habol.
Pwede pa yung mo habol, no? Motong gi-announce na ni Edel nga kuan, there's photo para
Okay, taking shot in 1, 2, 3. Smile. Okay, all done, sir.
Thank you
All
very
right.
much.
Thank you, Mike. Del? You're on mute, Del.
Okay. Sorry. Okay, thank you to everyone who have participated in today's event. Now we have come to the conclusion in this afternoon's webinar. To formally close, I would like to call on again Mr. Buddy Villasis to give his remarks.
Thank you, Edel. Ladies and gentlemen, I believe that all of you have done well through this afternoon's webinar. It is my great pleasure that you had a fruitful discussion, though I think 2 hours may not be enough, but with the excellent presentations and active discussions of our handsome speakers, I can conclude that the purpose of the webinar has been accomplished. I hope that what you have learned through this afternoon will help you a lot in your duties. I am confident that you will leave here informed and enlightened as you move on in your vital work ahead. You know? We extend our sincere appreciation to PNA Grant Thornton through Boss Wendell, of course, his able leadership, and Attorney Kim Aranas, and of course, our beautiful moderator, Edel Ocanyada, for going out of the way in partnering with us to bring you today's webinar. Feel free to contact them or visit their website if they can be of any assistance related to taxation and other related business documentations. They are open for consultations. The video recording of this webinar will be uploaded at CIB.O's Facebook page. No, that's facebook.com/CIB.org.ph. You can always visit the page and review the video if you miss anything this afternoon. Of course, don't forget to like and follow the page when you visit, so we will be inspired to bring more webinars like this to everyone. I wish you all good luck in your work. Thank you and stay safe. Goodbye.
Thank you for that, Sir Buddy Villasis. On behalf of the Cebu IT BPM organization and PNA Grant Thornton, I would like to extend my most sincere thanks to our dear guests. I am pleased to have moderated this discussion, and we look forward to more collaborations with you all. Thank you, and stay safe.
Thank you. Bye-bye.